Alright class, Assalamualaikum warahmatullahi ta'ala wabarakatuh, and hello to all of you. In this video, I'm going to explain a little bit about the example of comprehensive financial plan document that I passed to you before the MCO. So as for today, we're going to look at several small items that you have to look at that in a serious way, because I'm afraid that because all of these things are important basically for the preparation of your financial report. The first thing that I would like to say today is about the date. So if you look at the document, if you look at the date of the financial report is on 11 July 2009, but if you refer to all of the calculation they have in the report, for example, if you look at the information related to the cash flow information, net worth statement, all of these calculation are based on 2008 information. Okay, so which means that based on the 31st December 2008 information, okay, I will try to scroll down and show that to you. Right here, you can see the net worth is as at 31st December 2008. So based on the information gathered or collected in the fact-finding sheet as at 31st December 2008, then they come up with this, they prepare this financial report and they submit this document to the client on somewhere in 2009. So this is something that you have to pay attention and take note on this. That is number one. Number two, if you look at the information here, for example, at this point of time you already completed your fact-finding sheet. Next is about to prepare the executive summary. Then you can see the example of executive summary that has been provided in this document. Okay, you can see, for example, the executive summary comprised of the strategies that are designed to provide you with cash flow to support your current lifestyle, have to be efficient in the tax planning. So you can choose, or this is actually the general guideline or example for you to prepare your own report that suit with your client. Okay, short-term goals and objective are the goals and objective less than 3 years, for example, to provide with sufficient cash flow to support the current lifestyle, etc., etc. And medium term refers to 3 to 7 years, while long term is more than 7 years. So for example, let's say in the next 10 years your clients will send their children to the universities, for example, so it is considered as a part of the long-term planning for your client. After that, what you need to do is to prepare the current situation. This is a standard format that you have to follow, and you have to calculate the asset, which comprise of both cash and cash equivalents, investment asset, and personal use asset. And this information actually similar to the one that you already collected in the fact-finding sheet. And after that, liabilities, and comprises of both current liabilities and long-term liabilities, as well as you have also calculate the net worth of your client, which means the difference between asset and liabilities. Okay. Next, you have to prepare this net worth statement, which is actually similar. The format are all similar to the one that you have in the fact-finding sheet, and you have to transform it in a better format, because you are going to include this in your report, and you have to make sure that the personal use asset that you have in the fact-finding sheet are based on the market value. Okay, personal residence, automobile, that is the current market value, and some information about the personal property, jewelry, for example, furniture and fittings. Okay, in the net worth statement, another things for you to consider is that the net worth, okay, the net worth of your client, it must be, you know, of course, you have to show that your client asset is higher than their liabilities, because at the end of the day you are going to give lots of suggestions to your client on how they can cope with their retirement planning, insurance planning, etc., etc. If they don't have enough money, or if they are trapped into debt, then it would be very difficult for you to give recommendation to the client. So this is the standard format that you have to follow. And yes, at the end of the day, after that you have to show the cash flow position of your client, what will be the inflow, the fixed outflow, variable outflow, the net cash flow, and again the net cash flow must be positive. If your client don't have a positive net cash flow, then it's also problematic for you to give recommendation to your client. Okay, so all of this cash flow information, where finally you are going to calculate the net inflow or outflow of the client and make sure that it's a net inflow. As in this case, you have to like basically consider or readjust whatever information that you currently have in your fact finding sheet. So if, for example, you found that based on the current calculation, your net worth and cash flow is not favorable, so it is the time for you to make a proper adjustment to make sure that your client have a positive net worth as well as a positive cash inflow. Okay. Alright, so next that you need to do is to look at the personal financial ratios and interpretation. And the financial ratios, and this part is all about to measure the health of your client's financial status, and it can be comprises of several ratios, which includes liquidity ratios, basic liquidity ratios, and you have the formula here, and you have to follow the formula that has been set. And as in this case, the document also provide you with the general guideline. For example, like basic liquidity ratio, it is from 3 to 6 months, which means in order to have a healthy liquidity position, your client's liquidity ratio must be within the range of 3 to 6 months. So let's say, as in this case, the clients has 4.26 of the liquidity ratio, means it is in a safety position because it is still within the range of 3 to 6 months. Okay, so next is about standby liquidity ratio, saving ratio, and you have to use the information that you have in the fact finding sheet as well as in the net worth statement for you to come up with for you to calculate all of these ratio. Another things I would like to highlight to you is about this, what we call as non-mortgage debt service ratio. Okay, non-mortgage debt service ratio. When we call it as a non-mortgage, it means the